What's up, guys? Anthony here. We're going to be talking about types of investment accounts. So you're probably getting ready to start investing and start doing it. And so we're going to go over 4 basic accounts that you can start up and what works best for you in your situation and what works best with your lifestyle and your goals. All right, let's start it off. So the first one we're going to go over is 401k. The 401k has a lot of pros and cons with it being an employer-based retirement savings. So cons of it, you can't withdraw until you're about 60 years old, 59 and a half. So you got to wait a long time before you can get your money out of it. But if your goal is retirement and that is your overall goal, 401k is great because it also lowers your taxable income. You can contribute 18 grand a year, which is quite a bit. Plus, you get employer match. An employer match is the highest rate of return that you can almost ever get because it's 100%. If you're with a good employer, obviously, because a lot of employers, they'll match 6% if you put in 6%, up to 6%. And a lot of them do up to 100%, which is nice. Some do less, but I know a lot that are 100% matches on it, which is free money essentially with 100% return. But some other cons, your money gets locked in the account and you have to loan against a 401k. And loan against a 401k is definitely not recommended. What you're doing is you're essentially taking out a loan against yourself. You have to pay yourself back interest. So you're still paying more for the item the way you want, but you're still paying yourself. So it's not awful, but definitely something you want to avoid because your money's not working for you then when you pull usually large chunks out. Because if you're going to take a loan, might as well be a larger chunk. No point in taking a $100 loan out against your 401k. You're also very limited on the amount of investment options. And these options are usually set by the company that you're working for. And this is usually through like the Vanguard and Edward Jones that your company's with. And a lot of times they're really strong bond or treasury ones. And they only have 2 or 3% return a year. But if you can get out of those and move more into an index type fund, which are usually definitely there, they're usually considered the most aggressive option within the 401k, you can then get 7 to 8% return on average a year return, which is good. But another, con with 401ks is forced withdrawal. So let's say you just want to build up this retirement account. It's almost just a side account for you, and you want to leave it to your kids. We necessarily can't do that because 401ks are taxed when you take the money out, not when you put the money in. And so the government wants to force you to take money out, which starts at 70, so they can start taxing that money and you have to take it out and things like that. So that's really all there is about 401ks. It's a very basic structure. Like I said, it's usually through an employer and not something you open up on your own. If you want to open something up like this on your own, I recommend a traditional Roth then. But here are some other options I think would be better when you're doing a solo investing strategy. So a Roth IRA, I know a lot of us have heard about these, but we're going to break down exactly what it is. So a Roth IRA can be opened up on your own, which is a big key for this, especially if you're going through this channel and you're following these steps, because you're going to be doing a lot of this on your own and not through a broker or an employer. So the pros with the Roth IRA is the investment grow tax-free. So at the age of 60, when you have $500,000 in your Roth, your 401k only has upper 400s. So it's almost $100,000 difference between the two, just due to being able to grow tax-free and not tax-free. And so the cons with Roth IRA, which makes this happen, is the money is taxed up front. So this is money that you've already gotten either through a gift, through an employer. It's money you already own and already have physically that you put in this account. But you only can contribute $5,500 a year. For some people, you'll never hit that $5,500. For others, they can hit it right away. And that's where that traditional Roth is more useful because you get a higher balance up on it. Unlike the Roth IRA, which is only $5,500. But there is no forced withdrawal on these. It can be passed on through the family tree, which is nice. So you can set this account aside, let it grow, buy Amazon, buy Apple, buy those high growth stocks, and then transfer it over to your kids or your grandchildren later on if that's just something you want to do and that's a goal that you have. You can also withdraw the principal without penalty, but not the earnings. So what that means is you put your 5,500 in, and I believe it's 5 years after the first investment, you can pull that 5,500 out tax-free and worry-free. Unlike the Roth where you have to loan against it, you simply pull out this money just like it was a bank account. And then after you put money in after the first year, it's only 2 year difference. But you cannot touch the earnings without getting hit with taxes and also a 10% fee. So always remember, you cannot pull against the earnings or the interest gained without a heavy tax and a heavy fee against it. Roth earnings also don't count as taxable income, which is nice. So you'll see with the other accounts, they get counted as taxable income, where the Roth does not. So whatever you make as earnings, so let's say you only make 20 grand a year, but your Roth, for whatever reason, you hit the jackpot on penny stocks, and you made 100 grand that year. Well, the government really only sees you only made 30 grand. So it doesn't affect your tax bracket in any way, but it does not lower your tax bracket in any way, unlike the 401k, which can lower your tax bracket. More investing options are also a big pro for this, but you're still limited. So unlike the 401k where you're only set with what your employer gives you, a Roth, you can invest in mutual funds, ETFs, stocks, index funds, commodities. You can do all that. You just can't do some of the hardcore trading, mostly like shorting and options and things along that nature. Due to you don't get the margin and it just locks your count up. But you get almost every option, just except for the really advanced stuff that most people with the Roth have no reason of doing the more advanced trading techniques. So just having the access to stocks and ETFs is a huge advantage over the Roth or over the 401k, which is really limited. Brokerage. Brokerage is going to be the one that I highly recommend, and it's the one I use. Well, I use all these accounts except for the last one here I'm going to be mentioning. But I have a 401k, I have a Roth, and I have a brokerage, and I have them set up differently with different aggression levels. With my brokerage being the most aggressive since I run it like a business. And when you own a brokerage, you need to run it like a business. When you have that open, that is Johnny LLC, that is Susie LLC, that is whoever's business. You don't get the benefits of a business, but you got to have the mindset that it is a business. Because your taxes income and you have to report it annually. So you have to understand how taxes work with these and how to file these properly, because they have special tax forms since it uses capital gains whenever you do a short-term trade. And a short-term trade is considered anything under 365 days. And so when you're doing these trades, you should look up how your tax levels are going to be affected based on them. So if you have a really low tax level as of now, short-term trades won't affect you that much. But if you have a lot of money and you're getting taxed quite a bit, a long-term trade might offer better value, because you can essentially usually trade tax-free if you hold something over a year, unless you're making a significant amount of money. Even still then, it cuts your taxes in half if you hold the stock for over a year. But you got to just think about that with your brokerage. What's nice about the brokerage, though, compared to the others, is there's no minimum balance. There's no maximum deposit amounts, unlike others. So if you want to put a penny in, you can put a penny in. But if you also want to put 100 grand in, you can put 100 grand in. It doesn't matter. And also with the brokerage, usually if you go through like a Fidelity, Scottrade, E-Trade, all those, you're also offered services where you get discounted trades, you get special services, like you get call-ins, and you can go to webinars and things like that based on the amount of money you have. The ability to invest in any way is really nice with brokerage. You can invest in any way possible that trading site offers with a brokerage. And it usually also matters, though, on what your capital level is, because sometimes a company will lock in what you're allowed to do until you hit certain thresholds or certain maturity levels in your account, just so, I guess, so for them, they know if you're able to do this properly type thing, or if you can handle the risk. You can also trade a margin, which can be a pro or a con. So what margin is essentially a loan that you take out with your trading company to buy stocks with. And you have to pay them back at the end of the month, whatever the interest accumulates on these stocks. The nice part about margin, the big pro it can gain you a lot more when you don't have a lot of money. And it's usually double what your account value is. You gotta remember, it's double your account value. So you gotta be a lot safer with this. So let's say you have 10 grand in, it'll give you roughly 20 grand to trade with. So it'll take your 10 grand in cash, and then they'll also provide you with a 10 grand loan to buy stocks. So you can quickly buy a lot of stocks if you know something's going to happen. Make your percent, because it's equivalent of 2% to your account, and then sell it. And make sure to keep your interest minimum on these and your fees minimum, and don't hold a lot of stocks long term on interest. If you're going to do long-term trades, just use cash, because its interest, I believe, is at 9%. So it's a pretty significant interest they'll hit you with if you have a lot of money you're doing this with. And another pro/con with brokerage accounts is you have full control. So you can dictate everything you do. You have full grasp control of your money. But the con with this is you don't have some guy who's been doing it for 30 years giving his advice essentially, or having his emotionalist like input or aspect or see-through on what's going to happen in the stock market. When you're more emotional, you act less rational, and you act more emotionally, and you do more freakouts, and that's when you end up losing a lot of money. So it's a horse apiece between full control. It really depends on the investor themselves, and if you're not comfortable with the full control, definitely go do mutual funds until you learn more and get more comfortable with it, because the mutual fund member has that professional managing that account for you. There's also some cons with it. Like I mentioned, it's taxed as income, and it has to report it annually. And you got to make sure you report these annually and report them correctly. You get monthly statements, which are nice, and just keep those statements in a folder somewhere, whether it be in your email box or you physically print them out or get them sent to you. Just keep them somewhere, because this makes your taxes a lot easier. Because you can actually you can also get tax benefits, and they're considered capital loss instead of capital gain. And so what that means is you lost money on a trade, and then you can deduct that from your taxes. And then there are certain tax strategies where you carry a loss over on the year, and then you report it as a loss, but you hold the stock until it's a gain, and then that gain goes on to the next year and not the previous year. There's all different tax differences you can do with this. But there's also fees and limitations on trading. So every trade, there's usually a fee to go in and a fee to go out. And there's also the limitations are, if you get caught day trading and you don't have 25 grand in your account, it's called pattern day trading. You can do 3 trades every business week, I believe, before you get called a pattern day trader. And if you do that, what ends up happening is it locks up your account. It'll either take away your margin, or it will lock your account so you have to process it, so you can do a trade every 3 days unless you have cash available. And like I said, with this con, it goes with full control. You have no professional help. It's all on you to do all the trades and the learning and everything like that. But like I said, it can be seen as a pro because you have full control. Maybe you see something others don't. All right, let's get to the next one. So I wanted to add this one because I think it's very interesting, and I'd like to make a video fully on phone accounts. And phone accounts are like Acorn, Robinhood, Stash, things like that. So they're like these free platforms that you can do on your phone with not a lot of money, is what they emphasize, or they emphasize it's for free. Or they say, oh, whenever you make a credit card purchase, whatever, we'll round up your change and you invest it. And I like the concepts, and I like the ideas, and I feel like more research has to be done on these. But what I found in it, so just some pros is the free commission to trade. So it doesn't cost you to go in and out, but I believe they take a percentage of your earnings, or they offer like gold memberships within them. Nothing's ever free when it comes to this world, and don't ever think something is actually free. Usually, more you pay for something, usually actually the better off it is when it comes to the stock trading world. Because these people's services, they cost as much because they're very reputable. Another pro is it's a very easy to use app, but you can usually only do these by phone. And sometimes computers a lot better because it's quicker and because you can do a lot better chart analysis by phone, by computer, not by phone. But with the phone, you're obviously on the go, mobile. You can definitely check things and do things when you need to. And I feel like using the phone is easy enough when you're doing long term trades, meaning like a swing trade, like a week to 2 week type trade, over doing a day trade where it's obviously happening within the day where you gotta do more chart analysis. It is regulated by SEC, I found out, so that's safe to use. That's the Federal Trade Commission, so that's big. It's also good for small accounts. So what I've been seeing is a lot of people have like $1,000, $500, something like that, and they're usually very small. Not like the typical brokerage account, which has in the thousands of dollars or higher. So some cons that I found out with the phone account: you're very limited on your trading options. I think you only can buy stocks and long them, and that is simply it, which is not a bad thing, but it really pigeonholes you to a certain type of thing, and that can really affect you when markets are acting all wonky. But for a beginning trader, it definitely isn't bad, but as you progress, it really constricts you. You only can use mobile, like I said, so it limits the amount you can physically do because they do not have a good analysis tools within these programs. There's also no or limited or technical analysis tools, like I just say it. So research is bare minimum, where if you go on Fidelity on the computer, everything you could ever want to know about the stock is physically there. Also, there's usually annual based fees on money in account for premium tier. This is what I was talking about earlier. And what I've seen is it's usually 1 to 2% of the money that you have in your account. So it's not even what you trade. So let's say you have quite a bit of money in it, but you never trade. You're just taking hits on your account without even doing anything. Or if you go through like a regular brokerage site, the only way you ever get feed or taxed or whatever is only when you do something. And actually, when you don't do something, you get paid a percentage, like a savings account at brokerage. I think Fidelity pays roughly 1% of money you leave alone, and I think they do it quarterly or biannually. So these are the 4 accounts that we've looked at, and like I said, it never hurts to have all 4. I have 3 of the 4. The phone account I'd be very iffy on or weary on. It really just depends on what you're comfortable with. If you don't have a lot of money, I don't recommend the stashed one, I believe it is, or it rounds up your credit cards, because you really just shouldn't be using credit cards. Because what you're doing is you're essentially investing on interest, and a lot of people don't pay off their credit cards every month. And if you're paying off your credit card every month, you might as well have a good chunk of money just to put in a regular brokerage account. So that's where I see the flaw with that one. But simply putting a couple dollars in these accounts, I don't think ever hurts, and it's definitely a good tool to get familiar with how the market works and stuff like that, and sort of get you chimed into how things run. I wouldn't get addicted to the phone sites, and I wouldn't expect a lot from them, but I think it'd be a good stepping stone or learning tool to get into it. Alright guys, thanks for watching. Make sure to hit that subscribe button, hit that bell button so you get on notifications on the new videos. I'm going to be uploading a lot more here. And have a great day, stay awesome, and hopefully the bull market's with you. Good luck out there.